Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. Happy Monday, 26th of September 2022. Okay, so this morning we got the UK, the pound, getting blasted overseas. Dollar up again. It seems like we're coming off the boil in terms of total panic here for right now. Futures have been improving throughout the morning. We continue to see the opportunity for a bounce, despite the horrible technical tape out there and ever rising yields. It seems like we sold some of our vol on Friday. We took off some of our inverse ETF exposure. We plan on putting on a larger vol position, but not yet. Market's oversold according to our work. Futures actually, again, recovering a little bit throughout the morning. Hard to say how far a bear market rally potentially could go. We've got earnings season coming up in October here, right around the corner. These numbers are not going to be as good as Q2, and the guidance is going to be a little more, I would imagine, measured and cautious. So I wouldn't look for a ton in terms of positive catalysts out of that necessarily. But it does feel like near term, smart money wants to buy this dip, especially in energy potentially. If you think about like an Oxy, if you think about the structural situation we're in terms of neglect of infrastructure, capital development, what have you, in the energy space over the past several years, it makes the services space look a little interesting, whether it's, Halliburton or Schlumberger. EQT on the E&P side, we own AR and CHK, or you could just maybe potentially play the XLE. Most of these companies are making money above $60 WTI. Still very strong cash flow, still the best profitable, most profitable companies probably out there right now, and some of the cheapest too for that matter. So it does feel like, and I feel like it's, smart money does want to buy that dip in energy near term. Also looking at long duration assets, long duration treasuries. It does seem logical still, the idea that we've seen peak inflation and that in the next 6, 9, 12 months we're going to be looking at some cooler numbers out there. Some go as far as say we'll be in a deflation environment in a year, like our friend Jeff Gunlock. So that looks interesting. Even something like a Walmart, we talked about this last week, gaining share out there. You're going to get the trade down effect from the Whole Food shopper and the boutique grocery shoppers going to trade down to a Walmart type thing for their groceries. 56% of their top line is from that grocery segment, so that looks interesting heading into the print. Their earnings report was received positively last quarter. Look at the gap up on the stock. And then let's talk about more. That's the near-term look, and then look more medium term. It does feel like all this is going to get bad enough for the Fed to blink, meaning. And we talked about this on our webinar we hosted last week as one of the potential outcomes. The pain's probably going to get bad enough, and likely something's going to break in the global capital markets. So whether it's probably going to be overseas, whether Credit Suisse goes down, whatever, I have no idea. But it feels like something's going to break out there. It's just too much stress, and a lot of these companies, whether it's sovereigns or what have you, are just in such a bad spot. That we'll see an accident, and that'll probably be the day that you'll see the 2-year gap up in terms of the bond, gap down in terms of the yield, because the Fed pivot's probably right around the corner. we're not there yet, but that's something to kind of think about in the back of your mind. So, um, and then you potentially you see the global concert of the central banks be accommodative all over again. But again, we're not there yet. So in the meantime, you got to survive to get to that. All right, so that's what I got. So near term oversold. I'm looking for a bounce. More taking off the vol, decreasing the hedges, and not doing it. I'll do a little nibbling on the long side, just because I have to. I can't help myself, but not going crazy, that's for sure. Still keeping a lot of cash. That's it. Have an awesome Monday. We'll talk to you tomorrow.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with an investment objective similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.